There we go.
All right.
All right, looks like we have some people here. So let's get started. I am Dorinda Hanson. I'll be the moderator today for this webinar with Christian. I'm a relationship manager with CORE. I'm going to remind all of you that it is being recorded, so don't say anything incriminating, but you can ask questions. It's always welcome and wanted. So I'll turn it over to Christian right now, who's our mighty, fearless leader at CORE, to go over today's webinar about talking to your banker about your numbers.
Thank you, Dorinda. I have a special place in my heart for bankers, having been a banker in a previous life. I lasted about 3 years. I couldn't take it anymore. I ran screaming out of the bank. And I'll try to keep my disparate marks about bankers to a minimum because I have lots of friends that are bankers and I don't want to talk crap on them. So basically what we want to do today is talk about your numbers from the bank's perspective. How do they go through underwriting? What do they look at? What are some of the options out there? Banks, non-banks, SBA, and then, you know, a little around what you may or may not want to share. Please ask your questions. I'll be happy to stop and answer them as we go. So there's Dorinda. That's me. I'm not sure how old that picture is, but it was a lot skinnier. I'm a lot skinnier now. How about that? All right, so let's start with Lending Money 101. The criteria for lending money has not changed probably since biblical times. It's three things: cash flow, collateral, and character. Cash flow is the most important. It's first there. Collateral is there because I think it's secondary, and then character is third. Not that any of them are unimportant. Pretty much all three need to be there, but they're going to start with cash flow, and it's not going to get to a conversation about collateral or character if the cash flow is not there. One of the things that is a misunderstanding with banks around collateral is that they don't want the collateral. When a bank looks at a credit, they're really looking for at least two, preferably three ways to get repaid. They don't want any risk. So the cash flow is the first and primary way they're going to get repaid. Collateral is only a secondary. So you may have great collateral and you may have great character as far as been in the community a long time, your business has been around a long time. But if the cash flow is there, they're not interested, because frankly, they don't want to loan money and then have to go repossess the collateral and sell it to repay it. That's just not what they're in the business of doing. It's just a secondary form of repayment. So this doesn't change. It doesn't really matter who's lending money, bank, non-bank. It's all predicated upon the same concepts. So cash flow starts and ends. Like I said, if you don't get past this, you're not going to get to go any further on the monopoly board. Generally speaking, unless you're a startup and startup dealing with an SBA loan, it needs to be historical. It can't just be 1 year. You know, there are exceptions to that, and there are you know, like if you were looking at this year, for instance, you might have a historically bad year, but you've got a couple of good years prior. So it's not that it has to be on the button for every period you look at, but generally speaking, 3 to 5 historical years of cash flow is what's going to support your credit. The other thing that comes into play is how you stack up against your industry. So things like how much cash flow you produce compared to your competitors, or if we get into the conversation about collateral and leverage, how leveraged you are compared to your competitors is going to be one of those factors that they look at. Collateral.
So Christian,
yes, go ahead.
When it comes to how you stack up to your competitors, how do the banks have that information? And is it important to choose a bank who knows about your industry?
Excellent question. So I'll answer the first. Back long ago when I was in banking, there was a company called Robert Morris Associates, RMA. I don't know if they may still be around. I'm sure the data is there, and maybe under just a different name they bought it. But RMA was bank reported financial information. So they took all of their loans, they took the financial statements from all of their customers, and they reported it to RMA. And RMA put it back into catalog format and gave it back to the banks. So there are a lot more tools now than there were then as far as industry averages. I think one of the reasons why they liked RMA was because it was bank provided financial information. So there was at least some credibility to the numbers. You know, you submit a financial statement to the bank and it's wrong, you've committed a federal crime. So there's kind of that hurdle to get over of whether that information is accurate. But, you know, like we use BizMiner, and I'm not 100% sure where they get all their data from, but, you know, it gives us the same information, financial statement line items, and ratios by industry and by size, geography, you know, all of those other ways you can slice and dice the data. Finding a bank that is specific to your industry can be huge. Here in Oklahoma, we have a lot of oil and gas, and oil and gas lending is a specialty. If most banks won't do it because they don't feel like they have the depth of knowledge in it. It really comes down to, and we'll talk about this in the different types of lenders, but your banks have to spread their risk out, right? So they can't have all of their loans in one industry. And if a community bank might do a loan in an industry that they don't have deep knowledge in, just because they're a good customer, have a good history with them, but that doesn't mean they're necessarily comfortable with it or that you're going to get the best terms on it because they don't really understand it. But I think that raises a great point. I mean, at the end of the day, when you're sitting across from your banker, is they need to understand your business. They need to understand how you make money, and they need to know what it is that you're going to use the money for. One of my board members, and this is probably politically incorrect, but I'm going to go ahead and tell the joke anyway. One of the board members at the bank that I worked at, he pulled me aside after a loan committee meeting, and he said, you know how a financial statement and a bikini are similar? And I said, no, how? He said, well, they're similar because what they show is interesting, but what they conceal is vital. Oh, okay, I get it. Did that answer your question?
That did, thank you.
Okay, so looking at collateral, like I said, it is secondary. Once you start looking at collateral, then this concept of leverage comes into play. Leverage is essentially how much debt to equity you have. Some industries obviously have a lot more than others. You know, if you're in a capital intensive business like oil and gas or manufacturing or warehousing, you might need a lot more to do your work than, say, a professional services firm like ours, where we don't have to go buy a lot of equipment to do our job. And that's where the industry comparison comes in. So comparing a professional services company's leverage to a company that's in manufacturing, that's apples and oranges. But the concept here on leverage, and as it relates to collateral, and we'll get into this in a couple of slides later, is this idea of loan to value. So think about it when you go buy a house, your personal residence, depending upon the loan program you use, they're only going to loan you a certain percentage of that collateral. You know, you might get an FHA loan and only have to put 3% down on a personal residence. But in the commercial realm, you're not going to get that high of a loan to value. But that's where that leverage comes into play. Types, pretty much anything can be collateral. Again, you're looking at the secondary nature of repayment. So as long as it's got some value to be resold, you can use it. We had at the bank that I was at, we had this rule that we would take anything as collateral as long as we didn't have to feed it. So we did no ag lending, but there are banks out there that take livestock as collateral, or crops, or inventory, accounts receivable, of course, real estate, stocks and bonds, even closely held company stock can be used as collateral. And then the valuation, that goes back into that leverage conversation of how are they going to value it. We actually bought a building. We bought our Tulsa building from Bank of Oklahoma. It had been repossessed. And I remember talking to the special assets officer who was in charge of getting rid of it. And I said, what's your price on this building? And he told me X. And I said, well, what's the appraisal on the, and he goes, you don't understand. I don't care what the appraisal says. That's just a piece of paper. I'm telling you what I'm selling it for. That's the value. And that's an important point, because the valuation is subjective, right? It's somebody's opinion. And usually it's at a point in time. So a valuation of collateral can change greatly and drastically over the time of the loan. But how it's valued is critical. One of the things that you might run into when you're trying to borrow money on equipment, for instance, if you're buying new equipment, it's easy to determine the valuation. It's what the invoice price is, right? But if it's used equipment and it's still very valuable, you might actually have to go out and get an appraisal on that equipment to be able to borrow money against it. Generally what they're looking at, just like they're looking at an appraisal on a piece of commercial real estate or a residence, is they're looking for a professional opinion that they can sue if the deal goes south. They just want someone else on the hook to say, yeah, this is my best guess as to what it's worth. I didn't mention character, but one of the things that we've seen with the advent of technology is a lot more character decisions are being driven by credit score. In other words, the old character of, am I going to get repaid? It speaks to the intent of the borrower, not do you have the cash flow and do you have something to back it up if things go south, but do you intend to repay me? Most of that has been taken out of the realm of subjectivity of how do I feel sitting across from this guy or gal loaning them money, to more of looking at their credit score, even on the commercial side, to say, does this person consistently pay their bills? I find that business owners tend to have dirtier credit reports than employees, tax liens, maybe lawsuit judgments. So, the banks have some discretion. They're not just looking at it like you would in a residential real estate loan product where, you got to have a FICO score of this or you don't qualify. They've got a little more flexibility in that, but it's still a huge driver. So this is talking a little bit more about the different collateral types, and I'm going from the top to bottom as the most advantageous, most borrowable, most desirable from the bank standpoint. And this is just from the commercial realm. So commercial real estate that you occupy at least 50% of is the gold standard. You can borrow money on that all day long with the most advantageous terms. The second most is real estate that you don't occupy. That's generally classified as investment. Both of those are going to be, and this is with a traditional bank, non-SBA, they're going to have a maximum amortization or payment amount based upon 15 years, but the terms are usually going to be no more than 5 years, and that has to do with interest rates, which we'll get into in a further slide about how the bank makes money. But they're not going to lock the loan up for 15 years. The rate is going to be readjusted at least every 5 years, and it also gives them the ability to review the credit. It's not just about interest rate, but it's primarily interest rate driven. So then we get down to equipment, things that banks can repossess and sell. That's easier. I can go pick up equipment as long as it's not bolted down to the floor, and I can get it resold pretty quickly. Usually 5 years, but up to 7 years on that equipment, depending upon the type of equipment. I would throw all of your vehicles into that category as well, even though they may just be standard F-150s. What we call intangible assets, which are things that you can't touch, accounts receivable and inventory. Inventory you can touch, but generally consider that much more risky because of its nature. It's short-term in duration. You might have a receivable and it's only good for 30 days. After that, you collect it. So if I've loaned money for you on accounts receivable, 30 days from now it's gone, I don't have any collateral. Same thing with inventory. Usually those are only done in short-term loans, 1 year, maybe even less, on a line of credit. The line of credit thing, I've seen a lot of commercial banks get out of because they're expensive to monitor. A lot of the banks will do a line of credit and try and back it up with some secondary collateral like a second mortgage on the real estate so that they don't have to keep track of the receivables and inventory. But there still are banks that do traditional asset-based, that's what they call this, asset-based lending, where they're going to monitor the credit and you'll have to turn in a borrowing base periodically, usually no less frequently than a month, that's saying this is what my accounts receivable is, this is what my inventory is, and this is how much I have as collateral, and sign off on it. So those are the basic collateral type parameters. So let's go through an example of a cash flow. So there's a lot of, this may sound strange, but there's a lot of different ways you can calculate cash flow. Just speaking from a commercial banking perspective, 9 times out of 10, they're going to use your tax return. And the only time they wouldn't is if you've got some type of audited or reviewed financial statements from a CPA firm to substitute for that. Most businesses don't, so that's why they default to income taxes. They like the income tax return because they feel like that's a little more safe. You signed off on it to the federal government, so the numbers got to be somewhat accurate, right? So basically what they do, just say, take this example of the corporate return, the bottom line was it showed a loss. They're going to add back some items to get at their cash flow computation. They're going to add back usually depreciation and interest. And then they're potentially going to add back the owner's compensation, because in a commercial sense, that a lot of times is discretionary. It's not necessarily the value that the owner is worth, or that the cash flow is not available. And then, so we look in this situation, this company actually has a net positive cash flow for lending purposes, whereas the income tax return showed a negative. But that's one of the things that we run into consistently with our clients is they never show any profit, and then they go to the bank and they want to borrow money, and the bank says, well, you don't make any money, we're not going to loan you any money, and it's like, why not? So understanding this calculation and how it impacts your ability to borrow money is key for business owners. So taking this example a little further, let's say start with that cash flow, and let's say we've got a loan request, and this existing loan is a small loan. It's only $1,000 a month, and so that's 12 grand a year, and you want to borrow money, and it's going to cost $20,000 a year to debt service. So we come down to this pro forma cash flow of $11,768. So all that's saying is, we take your cash flow, we take out the debts that you're gonna pay, and this is what's left over. That number needs to be positive. Generally speaking, it needs to be 1.1 to 1.2 times the debt service. So that number is at the bottom there. It's called a cash flow coverage ratio. And basically what we're doing is we're taking this net cash flow divided by the debt service, the 32,000, and that gives us 1.36. So that number would be sufficiently above, the 1.2 for them to say, yeah, that passes muster. So then we go to the collateral question. So let's say this loan's a $300,000 loan and we're doing it on commercial real estate. Standard loan to value on commercial real estate, owner occupied, would be 80%. So they're going to loan you $320,000. So if your proposed loan amount was 300,000, you're fine because your 320 is higher than the 300. They'll do that loan, all things being equal. But let's throw a kink in there and say you have an existing mortgage on there that's 100,000. Banks don't like doing second mortgages to other banks. They might do a second mortgage on their own, but more times than not, they'll just refinance the first and be in the first position. Because if you have to liquidate collateral and you're down the line, it gets increasingly harder to get any of your money back. But let's just say they've got an existing first mortgage on it. Well, in this case, your loan to value of 320,000, take off that 100,000, the amount that you could borrow is only 220, not 300. So I say that to say, well, you say, well, I've got a commercial property, 400,000. Why can't I borrow the full amount? Well, you've got to adjust to 80% and then take off any debt that you currently owe on it. This calculation, by the way, is the same pretty much for any collateral, except that this percentage of loan to value is going to change. You might be able to get 90%, say, on accounts receivable less than 30 days old, but you're only going to get, say, 50 cents on the dollar on inventory. It really goes back to how easy is it for the bank to liquidate and how much of a haircut are they going to have to take in getting rid of it. And understand, they want to get rid of it quickly. They don't want to leave it on their books. So, they repossess a piece of real estate, they're going to turn it quickly. All right, so let's talk about lending options. I'm going to start with the business of banking. So how do banks make money? In a typical bank or a bank lender, not a non-bank lender, you have depositors. Those are you deposited in your money in the bank. They pay you 0.1% interest, and then they turn around and lend it out. That is the basic model. They make money off of the spread. So let's use a real simple example. If they're paying you 1% on your savings account and they're loaning that out on a car loan at 4%, they're making 3% gross, okay? So that's called the spread. But the factor that's not in there is the risk. So how many of those loans are going to go bad? And they've got a real good way of predicting that based upon a portfolio model. So they know X number of car loans are going to go bad versus X number of real estate numbers. They've got a lot of history on that. But that affects the spread. So our target in the commercial side was 2%. And that's net. So if you take all of your overhead, administrative costs, and loans that go bad, we wanted to get a 2% spread. That's good. Banks can make good money on that. But the thing is, you can't have a lot of loans go bad. You can't spend a lot of time monitoring loans because you got to pay people to do that. And then the third thing is your cost of funds. what are you having to pay your depositors? So this is the basic model, but then that allows me to talk about banks versus non-banks, okay? So let's start with banks. The current COVID pandemic and the PPP loans and all of that really showed the problem for most small business owners dealing with big banks. There's already lawsuits against Wells Fargo and Chase by small business lenders, small business borrowers that were completely blocked out and shut out during PPP. And they'll get some money because the Wells Fargo and those guys, they did it the wrong way. But it kind of goes to, what are you looking for in a bank? A national bank like a Wells Fargo or Chase are going to be really good at corporate credit cards, equipment leasing, unsecured lines of credit, like they're credit cards, but unsecured lines of credit. They're going to be expensive, but they're going to be available. They've got that streamlined, and they're good in those situations. They've got, really good personal products a lot of times, but from a commercial standpoint, the national banks for small businesses don't really do much. If you're borrowing $1 million, to floor plan a car lot, yeah, then they might be able to help you out. But for most small businesses, the national banks are not the ones you want to be borrowing money from. Going down that list, then you'd have a regional bank, which would be multiple state. And I chose Bank of Oklahoma or BOK for that as a good example. Some of the benefits of national, but a little more flexibility, a little more service, but not quite what you get when you go down to a state or a community bank, which are significantly smaller, but they're going to have more. You're going to know who your banker is. You're going to be able to talk to your banker about what your situation is and what you want to accomplish. It's going to be more based upon face-to-face and character. You're going to be able to explain things in your credit file. Well, yeah, I had a tax lien, but that was my accountant's fault, and we got it released, but it hasn't been removed from my credit report. Those kind of conversations you can have with a state or a community bank, a smaller bank, but you're not going to have it with a national or usually a regional bank. The community bank, this is everything from the, $50 million Fletcher Bank of Oklahoma, all the way up to RPC is a pretty good sized bank here in Oklahoma City and Tulsa that is still got a community aspect to it. So moving to the non-banks. So I want to see if I can figure out how to back up. Okay. So the banks have depositors, right? So if we go to non-banks, where do they get their money? Well, they get it from banks, usually, or investors. So what does that mean? That means their cost of funds is already higher. And that means that their rates are going to be higher because they've still got to maintain that spread. Non-bank lenders typically are more expensive, but they're also more flexible and are willing to take a little more risk. So some of the non-bank options that I've seen out there are merchant credit card financing. There's a bunch of those that sprung up about 10 years ago, and there's been a lot of activity with the current pandemic. But basically the process is all the same. They run your credit cards and they advance you the money on it. And so they feel comfortable getting repaid because they're getting your merchant credit card receipt. So you run a credit card for a customer or a client, they're getting paid back. And so it's more of a revolving facility, but it's much more short-term, and it's expensive because when you look at it on what you're paying on an annual basis, it's a lot. I mean, I've seen 30, 40, 50%. But it's real easy to get, and it's immediate. The problem is you don't want to be in that space very long. That's a worst case scenario in most cases. Same thing with factoring. Factoring is a similar concept, but it has to do with your receivables. So a factoring company is going to say, okay, you've got $100,000 in accounts receivable. We'll advance you $80,000 on that. And now all the payments are coming to us. And so your vendors, your customers send your checks to that factoring company. They apply it to your loan. And if there's anything left over, they'll give it back to you. The fees on that are also very expensive. They're going to be looking at the credit worthiness, not of you necessarily, but your customers. So if you've got high quality receivables, like from Walmart or from a national company, you're going to get better terms than if you're talking about, Joe's Tire Shop. Some banks have a factoring program that they offer. It's not the bank doing it. They just work with a third-party factoring company and offer that as an option. But again, just kind of like the merchant credit card, this is not a space you want to live in. This is a place that you want to use and get out of. Moving back down that line, then you have cash flow lenders. There's a company, I don't remember their name, but they are real heavy in the medical space. So if you're a doctor or a dentist and you want to buy a practice or buy equipment for your starting up a practice, they'll fund it. They're kind of niched into that professional space. They're not necessarily looking at the collateral to repay you. They're looking more at the cash flow of the business to pay them back. A lot of times they don't even file any liens on your equipment or receivables because they don't want it. But again, you're going to pay a premium for it. A cash flow lender right now, you might be paying 12 to 14% interest. But the flip side of it is it's a loan the bank won't do most of the time, or not, at least outside of the SBA. Some other options. Equipment lenders, I had one on the top of my head and it just left, but there are finance companies that's all they do is finance equipment. It's usually better terms. They'll work with you on leasing options, but it's going to be narrow on the collateral. They're not going to want to do anything on anything but equipment. And then industry financing. So a lot of time, I should have put vendor financing, but it's kind of like this. If you go buy something from Case, they'll finance it for you. And they usually can give you a pretty good rate because they're making money off selling the metal. They don't really need to make a premium on the financing. But those are also some options that come into play when a bank won't do it. And they'll give you better terms. All right, now comes to the favorite part of the conversation. SBA, don't use the PPP word. That's because Dorinda will tell you that that's been a nightmare, correct?
That's a potty word in our office.
You're muted. Or I can't hear you.
You just can't hear me.
There you go.
PPP is a potty word in our office.
Okay, potty word, so we don't use potty word. This is a real brief overview of SBA loan programs. We'll have another SBA lender come on and do a more extended presentation later this year. But these are non-PPP. So this has nothing to do with PPP or EIDL. So we're throwing all these out. This is normal non-COVID year programs. The main one is 7A. That's where most of the SBA loans are made. The PPP actually is a 7A loan. It's just a unique one. But the main program is a 7A. They also have a small loan, which just basically means that it's a streamlined underwriting if it's under 100,000, I believe. They also have something that really is unique and you can't get anywhere else, which are these cap lines that are intended to help contractors. And they'll actually loan you money on contracts, which no bank will do under normal circumstances. So I've got a contract to go build or sell the Walmart $1 million worth of product over the next 6 months. They will potentially loan you money on that so you can make the product. Another one that's not used nearly enough, in my opinion, is for international import and export. They will actually have some very good programs to help businesses sell product overseas, including working capital and streamlining the tariff situation. And then the last one is the 504 loan, and it's for fixed assets only. The best part of the 504 loan, because it's a complicated one and a pain in the ass, but the best part is about the 504 loan is you can get where you can only put 10% down. So you've got to meet some requirements on creating or maintaining jobs or improving the facility, or if you're constructing it new, that's fine. But those are a little more complicated. You still have to go through the bank, but they've got some preferential terms on real estate. Quick summary, loans of up to $5.5 million, maturity of up to 25 years. So commercial real estate, you can go 25 years out with an SBA and usually they'll fix it. Whereas with a traditional loan with a bank, you're only going to get 15-year amortization and it's going to be, due in 5 years. Interest rates are usually competitive, but they price them over prime. And there usually are fees, although some lenders will absorb some of those costs. The guarantee I put up there, that really doesn't affect you as the borrower, but just to give you an idea, you're borrowing money from the bank. The bank is loaning you money. The guarantee is from the SBA to the bank if you don't pay. So the SBA only gets involved after the loan is made if you don't repay them, and the bank comes back to the SBA and says, oh, by the way, Dorinda didn't pay her loan. I need to get made whole. But the whole SBA concept is to take a credit that might be on the edge because of cash flow, maybe history, maybe it's a startup, maybe it's not got great collateral. The SBA is designed to get over some of those humps, but it is not going to do a non-bankable credit. Because like I said, at the end of the day, these loans are on the bank's books. And so the bank has to be comfortable with the credit. It's just maybe it's got a little hair on it, as we used to say.
So what you're saying is you still go through the bank to get these loans. The SBA just kind of guarantees it to the bank that they'll get paid if something goes south.
Yes.
So you still apply for those through the bank, or is that through the SBA?
All of those loans that I had on here are done through a bank.
Okay.
They'll deal with the SBA and getting it approved. Some banks can do their own underwriting. Some have to send it to the SBA to get it approved. But you won't have to deal with the SBA beyond filling out their forms.
Okay.
Does that answer your question?
Yes, sir.
Okay. Eligibility is pretty loose. Retail, do we have any more of those? Do those exist anymore? Less than $6 million in revenue. Wholesale, fewer than 100 of people. Manufacturing, fewer than 500. They really want to incentivize manufacturing here in the States. Those are the general eligibility requirements. I've talked for 35 minutes nonstop. Questions? Surely not everything I said was crystal clear.
Must have been. We don't have any questions on the board right now.
Do you have any questions? Did I not answer anything that you had?
I didn't know about the SBA. I thought you went through the SBA to get your loans. I didn't actually know you went to the bank. I mean, I should have known that with the PPP we went through the banks, but I wasn't aware that's how it always worked.
Right. So the EIDL loans are done directly by the SBA, but normally those are just disaster areas, right? So that wouldn't apply in those situations. Yes. Yes.
Very informative.
Any other questions? All right, so we'll wave until the camera turns off. Thanks, everybody. Wait, I haven't edited it. Wait, there.